install it, you incorporate it for a specific narrow purpose. About red flags and what to think about in the shareholders agreement, you can apply that in this situation. Protect yourself, have the SPV, and have IDA sign the non-compete as well.
Special Purpose Vehicle, or SPV, which is a strategy that businesses and investors use to manage risks and optimize opportunity. Stick around, because in this episode we'll show you exactly what an SPV is and how you can use it to optimize your opportunities. Stay tuned, because this is going to be an amazing episode. And we are also powered by LE Fitness today, which we are very happy about. And remember, this is not legal advice, it's knowledge sharing. Kat, SPV, I heard the word many times, but please, what is it?
Special Purpose Vehicle.
Is it as it sounds?
Yeah, Special Purpose Vehicle. You put up a legal entity for a special purpose, a special narrow purpose. And what can be really confusing, it is not a legal structure.
Okay.
So it can be a LLC, a limited liability corporation. So it's not a legal structure. It is how that legal structure is used that makes us call it an SPV.
Okay.
So it's not an evergreen, your general broad business operations. You install it, you incorporate it for a specific narrow purpose.
That's why it makes it so special.
Yeah.
Okay.
And we're going to help you out here what to think about, because it might sound rosy and shimmery when you hear why. Because you talk about pooling of capital, isolation of risk, etc. But of course, there are pitfalls that we see often, unfortunately, because you set it up too quickly, you bring in different owners in it, and you haven't thought it through. So we'll go through that today.
Yeah, so where do we start? The first thing.
Let's go for an example. You get the opportunity to invest in this incredible new startup. It's called Bookface company.
Oh, that's the next one.
Yeah, Bookface.
Yes.
You want in. The ticket size in Bookface is 1 million, because they're attractive, and the attractive startups will shop around for investors, not the other way around. So you really want in, but you do not have $1 million US.
No, I don't.
So you'll miss out on the great investments. You'll be one of those angels scraping up the bankruptcy notes.
No, I don't want that.
No. What can you do?
Exactly. What do I do in that situation?
Well, you can turn around and deal source and say, you know what, I have this great opportunity to invest in Bookface company. And you turn to your friends and say, you know what, I got 100K. Or it doesn't even have to be your friends, because it's a specific purpose. They know where the money is going, so it's easier for you to fundraise, as it's clear what's the purpose. And you find other people who all have 100K. And when your 10 people have 100K, you pool the money into the special purpose vehicle. And in relation to Bookface company, you're one investor, you're one shareholder. So you have the sufficient amount to reach that ticket size, and you can invest $1 million US. So that's a brilliant way.
Yeah.
Suddenly you're much bigger and stronger, and you can get exposure to investments that you couldn't otherwise. They're really good startups.
But what happened to my friends that gave me the money?
Yeah. Here's the complexity. You have to know how to make decisions, because even if you're only a special purpose vehicle, only being a shareholder, you might have to vote in specific matters. You might get an offer to invest in further funding rounds. How are you going to take care of that? Some of you might want to participate and some of you might not. So that needs to be regulated in the shareholders agreement in the SPV, where you decide how to go about that. And if somebody wants to sell their portion, that might be fine, but you might want a right first refusal so that you can buy those shares.
We have an episode about that.
Yeah, about red flags and what to think about in the shareholders agreement. You can apply that in this situation. So that's important. You might even want to drag along, because there might be an offer to buy the whole SPVs because somebody wants to buy the whole stake in that book-phase company because it's so hot. How are you going to take care of that? You want to drag and tag along in the SPV.
So there's a lot of things to think about.
Yeah. So if you're going to contribute more cash, invest more money, if somebody wants out early, how to act in an exit situation, super important, tax considerations. There are opportunities often to put up a SPV in different jurisdictions. How will that play out? So always have a look at that. And we can also compare this because we had a masterclass about venture capital, right? In that case, you were the fund manager of Stellar Funds. Then you went to the investors and they put in money in a blind pool. They trusted you to manage and deal source and find those perfect portfolio companies, right?
Yeah.
In this case, you turn to other investors and say, this specific company I want to invest in. So be mindful of that difference because if you swap and turn it into a fund, you might be under other regulatory compliance requirements. So be mindful about the financial regulation in the jurisdiction you're in so you don't go and end up in trouble because you needed some kind of financial permit or something from the financial regulatory authorities.
But I mean, the person who invested, my friends then, what are the benefits for them?
They get the same opportunity.
They do.
They can invest in book phase. They couldn't on their own. Or even if one of your friends had enough money, they had $1 million to invest in startups. Well, they might not want to take would they really want to take all of their capital that they can invest in startups, high risk investments, and put it into one startup? By putting up SPVs and pooling money, they can gain exposure to more startups. So they might not even want to have more than 100K exposed to that book phase startup.
So it can be a good strategy as well if you want to sort out.
Yeah.
Okay.
And we have another perk.
Yes, what is that?
Imagine that this is before you were the successful fund manager of Stellar Funds. And you want to break into venture capital. You want to raise a venture capital fund.
Yeah, I want to.
Yeah, that's tough. How are you going to convince the LPs to put in that money in the blind pool? But what if you instead then make it easier for them to trust you by deal sourcing and coming to them with the great startups that you have found and that you have an offer to participate in the funding round? So this is kind of a backdoor building your track record to be able to further along the line start a VC fund. Because then you can show that I deal sourced and found a book phase. I found Graminsta and I found Loogie Loogle. All of them went on to be billion companies IPO'd. Suddenly you have a track record and you didn't have to put up the fight and getting all of the no's for the LP, getting nowhere.
Because you already have experience in your back.
But you did it through specific SPVs where the LPs didn't have to trust you as much. And you can even say that if this deal goes well, I want 15% on top of my own investment.
So it's a really good way to hijack getting into venture capital.
Yeah, it could be if you have high ambitions. Absolutely.
Wow.
But even if you don't, it's a great way to pool capital. So that's one. And we have another one. If we now turn it over and look at the business owner, and you do not want a messy long cap table.
No.
Because imagine that you're going to offer 25 of your employees stock options, and they will own 0.5% of your company each, and that's prior to dilution. Then they will own even less. So if they're on the cap table, and they're in the shareholders agreement, and you have no specific amendment clause, then you need to get the yes from them every time you're going to do. You have to have a formal voting on the EGM, or you're going to do an amendment to the shareholders agreement. It's a hassle. So annoying.
Yeah.
So you can offer them instead that all of the employees get to offered options or shares that will vest in the company, but they get to own through a SPV. So you get a one-liner on the cap table. You get a clean cap table.
Which we talked about in the episode. It's better to have a clean, structured cap table.
Exactly. So in this case, you are on the business side, and you offer the employees or any other minority shareholders to own through a SPV. And in this case, it's key for you to require or help set up a good shareholders agreement and make sure that they appoint a representative that represents all of those minority shareholders in relation to the company. It can even be that you say that they should give you the power of attorney.
Could happen.
Could happen. So it's very easy for you. So they're exposed financially, participating in the value growth of the company, but they cannot come and commingle with every little decision in the company, which would most likely make sense.
Do many companies use that?
Absolutely.
For their employees?
Yeah, the more experienced do. Absolutely.
It gets more structured and easy get going in the company.
Yeah, very helpful.
Really good.
Yeah. Can also help in exit transition if you don't have all of these on the cap table.
That's also good to know.
And another benefit, if they're in a minority SPV, they might not have as much information about what happens in the big shareholders agreement within your company. And they might not need to know everything. I mean, imagine that you get a partial exit along the ride and you get 25 million from a VC that buys secondaries from you, or etc. They might not need to sign the waiver or be informed. And that can also help to avoid jealousy or disputes or claims, what have you. So you can actually minimize the transparency in relation to those minority shareholders whose the intention, it might sound harsh, but the intention was to get the financial exposure, participate in the value growth, not them being involved in all of these strategic decisions.
So would you recommend companies doing like that?
Absolutely.
You would?
And then another one, again, think about taxes in this situation as well.
Yeah.
Always. And regulatory concerns. Always look at that. And also look at accounting, make sure you do everything correctly. I'm going to say always have legal advice and have a good financial advisor. But aside from that, another way is to isolate risk. So you see it as securitization, etc. But like we talked about in the joint venture, if you use an SPV to hold a specific assets, a licensing or something, and you feel that you isolate the risk and the obligations in that SPV in relation to your big business, do expect a savvy partner to demand that you, the big business, act as a guarantor for that SPV. So I hear a lot about it's so great with SPV because you isolate the risk if something happens. Well, most business partners will say, brilliant, but I want you to be a guarantor for any obligations of the SPV.
So that's good to remember.
Yeah. And on the flip side then, tip, if somebody uses an SPV towards you, imagine that you're coming in as a shareholder in my company. I'm going to give you 15% in sweat equity because you're brilliant. And you say, yeah, sure, Kat, but I'm going to use a holdco. I'm going to put up a SPV. So I'm going to sign a non-compete, but it won't be me signing it. It will be my SPV. And then you walk on and do something with a competitor of mine. And I cannot reach you because the only one who signed the non-compete was that SPV.
Oh, so the obligation will not be there anymore.
Yeah. So if you're exposed to somebody wanting to use an SPV between you and them, make sure that they as a person also sign.
Okay, that's really good.
Yeah. So to protect yourself, have the SPV and have IDA sign the non-compete as well.
Yeah, but that would be a thing that's like easy to forget about.
Yeah.
That would be a catastrophe.
Yeah.
Well, a lot of things we need to think of here.
And here we will also talk about a change of control clause that you can have in relation to the SPV, saying it's fine as long as you own it and control it. But if you, for some reason, sell that SPV, then you're personally liable or you have to sell the shares back or some other good consequence. And we have a specific episode about change of control.
Yeah, really good.
That's it.
That was all.
Yeah.
Thank you so much.
Thank you.
I mean, this is a really good strategy for you to use, but also know the details, which we talked about here, and avoid costly mistakes. So that was everything for today. And remember, this is not legal advice. It's knowledge sharing. And if you wanted to keep up your big legal muscles and rock your business, like and subscribe to our channel. Hej då!
Hej då!